Welcome back, you legends. I'm Dr. Cal, and this is going to be a quick market update video. So let's get right into it. All of the indices today are basically flat, with the exception of the Russell 2000 down 0.66%. Let's take a look at the different sectors and the stock market map. We have another mix today with consumer cyclicals lagging and retail stocks like Target also lagging the market. Tech like Microsoft and Oracle down, Apple up 1.7%, semis basically flat, energy in the green, and financials in the green. Let's take a look at the different sectors today. Leading was energy, followed by communication services and technology, led by Apple. The laggards today were consumer cyclicals, led by the declines in Tesla. We also had real estate and healthcare. So it's a bit of a mix today, not a clear picture, and you can see that clearly on the daily chart because we had a tiny indecision candle today, an indecision candle with a small body and a long wick to the upside and a small wick to the downside. So this is a typical indecision candle, and it came after a major sell-off. Volume is half of the Friday volume, so there's no buyer stepping in here despite the significant level. At 443, we had buyers step in here. Once it failed, we got significant selling. Then once we recovered that level, we had buyers step in again, and we're seeing some buying, but not a lot. We do have this significant support line down below for this bull pennant. We tagged it once, twice as support. We tagged it once, twice as resistance, came close to it last week to tag it as resistance again, but the market ended up with that U-turn on Friday. So to follow up on the volume spread analysis that I did in the last video, legends, small candle, narrow body, small volume. There's no divergence here. It's just a small candle with a small volume. Not a lot to discuss. However, the RSI is now flagging below the 50 level. Whenever we're below the 50 level, the market is in a vulnerable state with higher risk to the downside. I'm still expecting this support line to be tagged down here between 440 and 441. This is a clearer picture here on the 1 hour chart. Let's tighten up those support lines just a little bit. There's the 441 area. The stochastic is in significant oversold territory. We do have a cross up today. The PPO still hasn't crossed over. The RSI is still below 50. So the market is trying to make a stand, but buyers are not showing commitment. And it's more obvious on the futures market. This is the futures 1 hour chart. Why do I mention this? Well, because I identified all of these bottoms and I shared every one of these double bottoms with a positive divergence on the hourly chart in the trading community, and every one of these led to a significant rally to the upside. We do have a double bottom with a positive divergence both on the RSI and in the stochastic on the 1 hour futures. However, notably, something different is happening this time. We'll see if it holds or not. Here's the difference, legends. Once we get the breakout, we usually get the RSI above 50 and it stays above 50, right? With the exception of the August sell-off, we had a double bottom. Once we recovered that bottom, we held above 50 and that was it. On the September 7th bottom, double bottom, once we got the breakout, we held above 50. Today, we were not able to hold above 50. We got rejected at the 50 reading on the RSI, and on the 1 hour chart on the SPY, we got rejected at the fast green moving average. Now, there are two possibilities. We could either be forming another double bottom here on the hourly chart, either with an equal low or a slightly lower low. Either one is possible. So the question is, are we going to get a sell-off tomorrow to tag 440 and then rally on the Fed meeting? Or are we going to rally to 445, this prior area of support, now an area of resistance? Whenever we're below it, it acts as resistance. Whenever we're above it, it acts as support. We are now below it, it will act as resistance. So the question is, do we rally to 445 and wait at that resistance on the Fed meeting day, Wednesday, or do we get a sell-off down to 440 and then rally from that point on into the Fed meeting? In either case, it's not much of a big difference, right? Whether we rally from 443 or 441, not that much big of a difference. the big move this week is going to come from this 445 level, this key level. We get a breakout above it on the Fed meeting. We likely go back to fill this gap at 450 and potentially get a proper tag of this major resistance line before we continue lower to follow the bearish seasonality. Seasonality in September, legends, tends to be bearish in the latter half of the month, especially in the last 7 trading sessions. These below are the trading days, not the dates. So the 13th trading day in September is, let's measure it from September 1st to the 13th bar. That's September the 21st. So one day after the Fed meeting is the 13th trading day. We usually get a top in the market between the 13th and the 12 trading days in September. That means either a top Wednesday or Thursday. That's purely based on seasonality. We can get a top a few days earlier. We can get a top a few days later. It doesn't matter. The big picture is latter third of September tends to be bearish. So at a minimum, we expect to tag this support line before the end of September for a potential for something that looks like this, consolidation or distribution near the support line. The more times we tag a support line, the more likely it breaks. And this could end up being a huge bear flag for another leg down to 431 to end the month or potentially hit this level in October. Because remember again, legends, October seasonality tends to be pretty bad again in the second half of the month. So we're looking for a sell-off either down to this support line at 440 or lower at 431 to fill this gap by the end of September. If we form a low at 440 in September, we expect 431 to be hit in October. If we hit 431 by the end of September, we expect to tag 420, this key support level to fill the gap at 422 in October. So end of September, either 440 or 431. End of October, 431 or 420, either one of these. Really depends on how bearish the market gets toward the end of the month. We expect that price action this week will again revolve around this key 445 level, either tag 441 and go back to test this resistance at the Fed meeting, or rally to that level at the Fed meeting, then come back down and tag 441. And if we get a rally after the Fed meeting, I expect this gap to get filled at 450 and for a proper tag of this resistance line. So upside targets 450, downside target 441, at least, with 445 acting as a major pivot zone again this week. Very short term, the stochastic is oversold in oversold territory. It did cross over in oversold territory. We usually form bottoms when you cross over in oversold territory, with the exception of this massive waterfall sell-off. We did end up bottoming, but after shedding significant percentages after the cross has already been made. This is the crossover. It came in August 17th. The market continued to decline by an additional 1.6%. In this example, though, legends, this crossover is more decisive. Look at this. This crossover was much weaker, tagged several times. This one is more decisive. So that should cap the downside to 441, this support line. And I do expect buyers to step in here. This was a previous level of resistance. And every time we broke through it, we went higher to 445. Every time we broke through it, we went higher to 445 or above. So now I'm expecting either 445 or tag 441, and then continue higher to 445. How do we know which one is going to happen first? Well, pretty simple. Look at the fast moving average. If you're part of the community, the trading community, you will have access to this trading chart. This is a proprietary set of moving averages that I developed and tested, back tested over several months, and it's been working absolutely amazing for us. Look at all of these tags. It's been absolutely unbelievably accurate. Look at all of these tags. So if we take back the fast moving average, the green moving average, expect continuation higher to 445, then a decision to be made after the Fed meeting, depending really on a lot that's going to happen at the Fed meeting. That's either indication of a rate hike in November or not, questions asked at the Fed press conference, and the overall tone of Jay Powell. All of that will be important. I would not be surprised at all to get a tag of both of these, both the support and the resistance within the exact same week. Now let's take a look at the key chart, the VIX. This green moving average is the 50-day moving average. Down below in blue and black is the S&P 500. Whenever the VIX is above the 50-day, the market is in a downtrend. Whenever we're below the 50-day, the market is in an uptrend. We tried to tag it twice now, rejected every single time. Every single time we tried to clear the 50-day, we got rejection. However, momentum is now shifting in favor of the VIX moving higher. We do have this double bottom with a positive divergence. It is more obvious on the 2-hour chart. Here it is, lower low on the price action, higher low on the PPO. With that said, so far we have rejected the 50-day again, so buyers will try to buy this again, especially at this key support level. Ideal case scenario for the bulls is we continue lower to 441, find support here, market rallies after that to 450, fills the gap, tags this resistance. This would be the ideal case scenario for both the bulls and the bears, because that would give the perfect entry for the bulls and the perfect entry for the bears. What about the high yield bonds? Do we still have a bullish divergence? Well, no, the bullish divergence has been taken out. We had a higher low Friday. We are now making a lower low. So the bullish divergence is out in the smart money. However, if we continue lower and make a higher low here, we would still establish another bullish divergence, especially if the S&P 500 makes a lower low versus this low from September 7th. So again, if we go down lower here, we establish a lower low, high yield bonds, the smart money, they move lower, they establish a higher low that would create divergent lows and establish a bullish divergence that will help fuel the market rally back higher and fill this gap. Let's take a look at the NASDAQ. The NASDAQ today, again, to the dot, to the cent, to the penny, tag this support line. I am now waiting patiently, very patiently for this support line to break, because once that happens, there is absolutely no support at all the way down to this prior swing high from August of last year to fill this gap at 332. The downside we're talking about, legends, is 10%. 10% in the NASDAQ by the end of October. That's what I expect once this support line breaks. Remember, legends, the more times we tag a support line, the more likely it breaks. The analogy that I draw is the more times you hack a tree with an axe, eventually that tree will fall. And now bears and sellers are hacking away at this support line. And overall, look at this, legends. PPO momentum looks very weak, exceptionally weak. Look at this, barely above the zero line, and we're already crossing back down. So nobody likes tech, nobody wants to buy tech, and that was evidently clear from that rotation from last Thursday that I discussed. They sold tech Thursday, they sold again Friday. What did they buy? They bought energy, they bought real estate, they bought basic materials and utilities. They did not buy tech. What about the Dow Jones? Dow Jones, again, very close to this support line. Looks a little bit better than the S&P and the NASDAQ. That usually happens when the market is bearish. You see rotation out of tech and the S&P and into value stocks. That's basically what the Dow Jones represents. With that being said, still trapped in this range. It does look more bearish than bullish overall. There's an ascending 50-day moving average, and we spent the majority of the last couple of weeks trading below it. What about targets? Well, in terms of targets, I expect 344 to get hit, especially if the S&P tags this support line. I expect the Dow to tag that support line, and for the NASDAQ to break this support line for something that maybe looks like this. Break it, come back, back test, perfect short entry, ride it all the way down to these lows at 354. Take some off, continue lower to 348, this level, take some off, continue all the way down, book a massive bag of profits at 332. What about the Russell 2000? The Russell 2000 still in the process of potentially forming this head and shoulders top. The neckline is at 380. If we break 380, the Russell 2000 will establish a full measured move all the way down to the 52-week lows. That's 164, all the way down to 164. A full measured move, legends, for a head and shoulder stop is essentially taking the distance from the head to the neckline, doubling that, and you get the distance down to the full measured move. Again, I'm watching very closely whether we get a double bottom with a positive divergence here and we move higher, or whether we break 180. If we break 180, wait for the break, wait for the back test, enter on the back test, write it lower, and take profit at the full measured move. That's what I would personally do if I was trading the Russell 2000, but my preferred short at this time is the NASDAQ 100, not anything else. In fact, Russell 2000, I'd rather look for individual stocks, individual small cap stocks, and buy them as the market moves lower, accumulate for that huge counter rally into the end of the year. Let's look at the weekly BPSPX. Just above 38.4. Still, if we close below 38.4, we get additional weakness and likely take out these lows. I talked about that in the last video. I'm reiterating it again because it's absolutely important and it will be a decision-making signal for me. XLY divided by XLP, we have our decision. The decision was to close lower, take out the 10-day moving average. I discussed this wedge formation that was forming right here. Once we broke and we held at the 10-day, I said wait one additional day. If we break below the 10-day, that is the confirmation. We got the confirmation. We are now very likely forming a huge double top with a bearish divergence. Look for significant downside on Tesla, Amazon, cyclicals in general, consumer discretionaries in general, for a sell-off all the way down at least to the neckline, if not lower. Again, if we break the neckline, double the distance from the neckline to the double top, we get a target down to 2.05. That means the discretionary sector will fall by 15%, roughly 15% more than consumer staples. That means if staples stay flat, expect consumer discretionaries to fall by 15%. If staples fall by 5%, expect the discretionaries to fall by an additional 15. That means 20%, so on and so forth. How would I trade this? Pretty simple, legends. Enter a short trade here, put a stop loss here, ride it all the way to the neckline. If the stop loss is triggered, you exit the trade. You would be risking, let's see here, you'd be risking 1.5% to make 6.5%. That's more than a 4-to-1 reward to risk ratio. That's an excellent risk reward ratio. Anything above 2 is good. Anything above 3 is outstanding. 4 and above is absolutely exceptional. So this is an exceptional risk reward. Just know your risk, manage your trade well, and look for vulnerable stocks in the XLY. You do not necessarily need to short Tesla, Amazon, or anything like that. Look at the XLY. What are the weaker parts of the XLY? Look for weak companies in the XLY. Stuff, for example, that made a lower high versus this high. That would be another sign that these are weaker than the sector. I would look at stuff like that to short. You can also short the XLY directly. This is not financial advice. That's not what I would personally do. I would look at a company with very high traded volume, very liquid options chain, and buy, put spread, put a stop loss based on the stock price, not the option price. And if the stock takes out this high, I would exit the trade. Otherwise, I would ride it all the way down to this neckline. What about the NASDAQ relative to the S&P 500? We have our bearish cross. This now pretty much, legends, looks like a nasty left shoulder head, right shoulder for the NASDAQ. Expect a big breakdown in the NASDAQ relative to the S&P 500 ratio, in line with the break of this trend line that I expect to happen in the next 7 trading sessions. What about the summation index? Still moving sideways, new decision made. Again, legends, whenever we're moving sideways like this, we usually establish a period of a lot of volatility, chop sideways moves that end up with a bottom. Again, that bottom I would put at the 3rd or 4th week of October. That's what I would look for, a bottom. That's because seasonality. tells us October tends to be the perfect buying opportunity if you want to ride the November-December holiday rally. Let's take a look at the fear and greed reading 48, still at neutral, moving sideways, not much going on here. Market momentum showing greed is declining though. Stock price strength moving sideways, really struggling to go up. Stock price breadth trying to make a double bottom, potentially will make a double bottom with a lower low, just like this double bottom with a lower low, just like this double bottom with a lower low, just like this one, and just like this one. This is the more obvious one, double bottom, lower low, and that established the October bottom. So I'm looking for that double bottom to finish anywhere between the end of September and about the third week of October. Put to call ratio, is that moving back up? Does it look like a bull flag? Does it look like a triple top? Not clear yet, not clear to me yet. However, the CPC hasn't yet produced a buy signal. We're getting very close potentially to producing a buy signal. Not there yet. The histogram is declining. Momentum for the CPC is declining. This tends to be a bullish indicator, not a bearish indicator. And if we get a buy signal, let's say by the end of September, that will align up really well with seasonality, because the end of September right here tends to be a tradable short-term bottom into early October. Take profit in early October, wait for the second dump in October, buy again at the end or middle of October, anywhere between the end of the second week and the end of the third week of October. Market volatility still below 15. As long as we're below 15, do not expect big breakdowns. For big breakdowns to happen, we need to see the VIX close above 15. A lot of bears, a lot of shorts are waiting on that signal. As soon as the VIX closes above 15, I expect a lot of short positions to start opening up. Economic calendar tomorrow, building permits, 8:30 a.m. Eastern time. Not really a market moving event. Market moving event is Wednesday afternoon, 2 p.m. FOMC economic projections and interest rate decision. The market is pricing in a 97% odds of no rate hike in September. The Fed is not likely to surprise the market. If the Fed is going to raise rates, it's going to do it in November. The Fed is still projecting another rate hike either November or December. We'll get more color on that on Wednesday. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.